on this edition of Next Africa.
3, 2.
The competition for Africa's space tech future. The UAE's Space 42 teams up with Microsoft in a bold venture to map the entire continent. And inflation, tariffs, and politics all weigh on the state of the consumer, but one retailing giant is optimistic for growth at home. Plus, creative returns, why one fund manager sees financial opportunity in the arts. Welcome to Next Africa. I'm Jennifer Zabasaja in Johannesburg. The space race is on in Africa. Elon Musk's Starlink has become the most prominent player in the sector, expanding its satellite internet coverage to many countries, including Ghana, Kenya, Zambia, and Nigeria. With demand on the rise for high-speed internet, the scene is set for increasing competition. The UAE space tech company Space 42 has actually already launched key partnerships to improve broadband access in sub-Saharan Africa. The company also recently partnered with Microsoft and Esri in a new ambitious program to map Africa. I sat down with Space 42 CEO of Smart Solutions, Hassan Al-Hassani, to get the details. Hassan, there's quite a bit of debate right now and discussion amongst a number of African economies and countries about licensing and regulations, especially when it comes to these LEOs, these low Earth orbits and satellites. Can you take us into the discussions? Because you talked about acquiring deals. How do you get there? Because this is 54 countries, very different regulations across the board. How difficult has that been to navigate?
So this has not been done in a very short term. It's been a while. They discussed. There has been a lot of discussions ongoing through us, through Esri, with the African nations, with the African Union, with the African space agencies. We've been actually building the momentum through such agencies. And I want to re-emphasize on the African Union Development Agency, specifically the Environment and Sustainability Director, where their involvement in such program to understand the need, to understand how do we actually go about this program, how will this benefit the different the different nations in this continent would be is very important to us. So we are partnering as much as possible all the different stakeholders, all the different key players in this domain, so that we make sure that not only that we're executing this program and we're mapping and that's it, but such base maps and such data could be really leveraged to the maximum or to the optimum for such nations and so forth. And as I mentioned, these local center of excellences that will be part of the local countries within the African continent would play a key role in building up on this data and creating even more capabilities in one hand, while also supporting, expanding the program and sustaining this program from our side. So they'll serve as the point of contact between us and these African nations.
And Hassan, before we let you go, I wonder how you view competitors who have already penetrated a lot of these markets. I mentioned Starlink. There is, of course, OneWeb. Amazon is also coming in. There's quite a bit of companies that are trying to do similar things to what Space 42 is doing. Can you compete with some of these other players?
Competition is always healthy, and as we benchmark ourselves and our capabilities to what the global market is presenting is an essential aspect to us as well. Nonetheless, we're focused on what we do best and what Space 42 is created to achieve. Today, Space 42 sits in a very unique position where we have the satellite communication part connected with the Earth observation and connected with the downstream, or the what we call the data processing and the geospatial data that we're creating. So we are offering not only the communication part, but the geospatial part, and connecting those two worlds through a lot of different means. Strategically, we can talk about IoTs and direct to devices, a lot of connectivities where the world of, or the science of where is connected with the telecommunication world. This is something unique about Space 42, and this is what we are focused on. We're more conscious about what we are building and what we are actually expanding our capabilities in, and this is what we will apply. And of course, comes at the top of our priority is how our services is going to be beneficial to these nations, beneficial to our partners and clients in general across the globe, and how it's actually benchmarks in terms of quality and capability and use cases against any other competition as well, without specifying any competition as we go.
And for more on the state of play of the sector across the continent, I'm pleased to be joined by two guests here. Our Bloomberg senior reporter here in Johannesburg, Loni Prinsloo, and also Caroline Mbugua, the policy director at GSMA Africa, joining us from Nairobi. Thank you both for joining us. Loni, let's just start here, because Space 42 is very keen on challenging Starlink and some of the others on the continent with their satellites. What is the challenge, though, that they're going to find in doing this?
Thank you, Jennifer. So with Space 42, if you come onto the continent, of course, you're taking on Elon Musk, who has 8,000 LEO satellites orbiting the Earth currently. So you have that sort of number of satellites that you have to sort of start taking on. Plus, you have a big continent, 54 countries, different policies, different sort of legislation that you have to comply to get a license. And then the returns are often not that good, especially when you go more into rural Africa, connecting individual customers. So there's all that sort of things that you have to deal with. Space 42 actually is doing something interesting. They are setting up on the ground, which is something that Musk has not been doing. So they are building centers of excellence, they call it, or training centers. They have also recently announced with Microsoft and Esri that they are mapping the entire continent. So yeah, so they are building relationships, if I can put it that way.
Caroline, would you agree with that? And how does it fit into the broader picture of connectivity on the continent?
I think what we need to first appreciate is that at the end of the day, the value of connectivity cannot be overstated. And right now, what you're trying to do is accelerate the connectivity and closing the gap, particularly because of the high connectivity gap we have in the region. And this is largely due to the coverage gap of about 11%, accounting for about 400 million population, and making sure that they can get connected. In terms of the technology to use, we've seen a combination of terrestrial networks and non-terrestrial networks now. And we do appreciate that at the end of the day, what consumers want is to get affordable service and to be able to connect and enjoy the transformative power of connectivity. What we are seeing in the region is, of course, there's a growth of interest in satellite players coming to the region to offer different services. And of course, this is something that is welcome. We've seen, like you mentioned, the likes of Starlinks and so on and so forth, acquiring licenses in the region to be able to do this. And it's something that the sector welcomes because, of course, we know the value of competition. The value of competition is in driving affordable prices and, of course, in driving innovation and investment. The value that we see is customers having options that they can rely on. But the question that we need to ask ourselves, what are we trying to address? And what we should be addressing is actually the biggest issue, which is a usage gap. And usage gap are customers that are already connected and are not using the service for different reasons.
Caroline, you said affordability quite a few times, which is where I want to bring Loni in, because in Kenya, we've seen some users dropping Starlink because it's not affordable. Is this yet at a place where the end user is able to have choices, as Caroline was saying there?
So yeah, so also, as Caroline said, there's still a lot of people that are not connected. This is for different reasons. Africa is a vast continent. It's very expensive to roll out your towers and your fiber into rural areas. The returns are low. So for some people and for some like schools or clinics, sometimes it is worth getting a satellite provider like a Starlink, like maybe a Space 42. Even though the initial cost is quite high, you pay $500 for a Starlink kit, for instance, dollars, and you pay $850, I think, for a Space 42 Starlink, Space 42 satellite phone. So that initial cost is quite high for an individual African consumer, but in some cases that's what you can get and that's how you can get connected. So in some cases it is worth it, yes.
Caroline, what's your concern at this point as we see more and more international players making a push into the continent and low Earth orbital satellites?
It's important for us to introduce competition and to protect competition as much as possible. It's also important to ensure that at the end of the day, the players that are coming on board are exposed to the same requirements, regulatory and otherwise. Having a balance is very critical so you don't distort the market as it is right now. So a balance in things like the regulatory conditions, the rollout conditions, fiscal policy responsibilities to the consumer, such as quality of service. It's important that we look at this holistically and make sure that we have frameworks in the region that can be able to support and ensure regulatory parity is critical. But at the end of the day, the services that are provided to customers, if they don't meet the price requirements that is needed, then it becomes very challenging to see accelerated adoption. Like I mentioned, access is not a big challenge. The adoption of these services is where all these players, satellite or even the terrestrial networks themselves, mobile network operators, and working with government and other ecosystem players is to come together and see how do we address the affordability issue to customers at the end of the day.
Caroline Mbugua, Policy Director at GSMA Africa, and also our Bloomberg Senior Reporter, Loni Prinsloo. Thank you both for that discussion and for joining us today. And coming up, we dig into the continent's retail realities with a look at the factors contributing to the changing face of consumers across the continent. Plus, why one of South Africa's biggest grocers has changed its strategy for growth. Welcome back to Next Africa. I'm Jennifer Zabasaja in Johannesburg. South Africa's Spar Group is reshaping its growth strategy. After years of investing in overseas expansion, the supermarket operator is pulling back abroad and freeing up capital to expand back at home. CEO Angelo Swartz told me future growth lies in a bet on high-margin sectors, challenging the country's biggest player in an increasingly competitive consumer market. South Africa has more retail space per capita than most emerging markets. With more than 1,400 shopping malls dotted across the country, retail is big business. And in the hunt for growth, many companies have looked to overseas expansion. The Spar Group is one example. Just over a decade ago, the company acquired licenses to operate Spar-branded shops in countries including the UK, Ireland, Switzerland, and Sri Lanka. I met the CEO, Angelo Swartz, at Spar's Durban headquarters. He told me local investment restrictions were part of that motivation.
I think that idea was driven primarily by South African legislation, which limited investment managers from investing too big a part of their portfolio out of South Africa. And therefore, many investment managers were really looking for South African companies to be proxies in other markets.
Spar is largely a wholesale business. In the UK, for example, over 300 independently owned shops all carry the same brand. They benefit from centralized marketing and distribution. In exchange, the Spar Group collects fees and leverages purchasing power with suppliers. But in recent years, its African revenue has far outpaced what it gets from Europe. Take Switzerland, a country with strong trade protection measures. Groceries there are often 50% more expensive than in its European neighbors. When Swartz took over as CEO just 2 years ago, he decided to divest the Swiss and UK businesses, materially strengthening the balance sheet.
When we looked at the businesses in the UK and the business in Switzerland, is our view that those businesses are subscale, and the amount of capital that it would have to go into those businesses to get it up to scale to meet our strategic ambitions would be misplaced.
Retail analyst Alec Abraham argues Spar's biggest mistake was taking its eyes off South Africa.
When you go into a new country, there's a very different operating environment, and you need to be focused to understand that market and to succeed in that market.
Back home, Spar is expanding its DIY and pharmacy businesses and is building out its liquor operations.
And I think with Spar being where it is and how competitive the South African market is, we really just want to refocus on our home markets.
That's because liquor shops in South Africa are expanding fast. Last year, they grew almost twice as quickly in the country as conventional supermarkets.
Our liquor brand, Tops, has been around for also about 25 years. And through independent retailers, we've become the single biggest retail liquor brand in this country.
Spar's CEO has branded this battle for shoppers as South Africa's wine wars, a high-margin, high-growth area in an otherwise struggling consumer market.
We have shown that our business has the ability, and our independent retailers have the ability to compete directly with the chains, empowered by us. And we are now the second biggest supermarket brand in this country, which is no mean feat.
Having sparred with what today are smaller supermarket rivals, Swartz may soon be ready to take on number one, ShopRite, in what could be his toughest fight yet. While big retailers compete fiercely for market share, consumers across Africa are facing a mixed reality. Squeezed by inflation, tariff uncertainty, and uneven economic growth, consumer confidence is walking a tightrope. Yet, signs of resilience are emerging in some markets. Let's dig deeper into the consumer story with Bloomberg's Africa economist, that is Yvonne Mango, joining us here in studio. So Yvonne, the South African consumer consumption, we're seeing it steadily up based on some of these charts and the research that you have. Why aren't we seeing that reflected, though, in the growth story?
Yes, so it's a good point. We're seeing through some of the proxies, including retail sales, that there's been a return to growth from about a year ago, and that's been accelerating. The reason we're not seeing it yet in the GDP numbers is because gross fixed capital formation, which is essentially investment, is still sluggish. It was negative in the first quarter, suggesting that we haven't seen a recovery on the investment front. But over time, as demand does pick up, we're expecting investment to begin to do the same.
Let's take a look at some other economies that you've dug into a bit deeper, and that is Kenya and Ghana. Very different stories about the consumer in each. Can you walk us through both?
Yes, so in the case of Kenya, we've seen the consumer is challenged and struggling. That's due to a cost of living crisis. I think we saw the escalation of that a year ago when there was the protests around the tax bill. This is as a consumer who faced both a high inflation post the depreciation of the currency, as well as an increasing tax burden, started to protest and said this was beginning to cause strain. And as a result, we've seen consumer confidence decline there. It's in negative territory, according to CASI Insights data. If we look across into West Africa and look at Ghana, there has been an improvement, particularly over the past 6 to 9 months in consumer sentiment. That's reflecting the fall in inflation. You may recall a couple of years ago, inflation was over 50% at one point. In the case of Ghana, it's now heading towards the single digits, which is very encouraging. It's helped by the fact that terms of trade have improved. As you know, they export gold, so the currency has benefited, and we're seeing inflation fall, as well as interest rates on the back of that, and that's helping improve sentiment for the Ghanaian consumer.
That seems like it's a bit of a sign of an approval of what we've seen the Mahama administration do early on.
True. So we have seen reforms as a result of the new administration, but of course they're also riding on the wave of debt restructuring, which has been positive for that particular country, similar to Zambia's restructuring story. So that's helped as well.
So it feels like there is not one blanket term for where the African consumer is. It really depends on, it's not even regionally based. It's which economy are you talking about? Is that safe to say?
Correct. It depends on domestic policy. But if we were to talk about themes we're seeing across the continent, the oil importers are benefiting from low energy prices, so we're seeing inflation relatively low in the case of South Africa, hence our governor wanting to, preferring to target the lower end of the target band of 3 to 6%. Similarly in Kenya, there's relatively low inflation. It's an East African story, so that is helping the consumer. But what's also encouraging is that in countries that have had double-digit inflation, such as Nigeria, Ghana, as well as Zambia, we are beginning to see a slowdown. And so over the next 6 to 12 months, we're expecting sentiment to improve in those countries as well.
Is there anything interesting you find about Tanzania? Because that is also something that Kazi Insights tracked a bit closely.
True. So sentiment there has been generally quite positive. Tanzania has been pretty good at managing inflation, keeping it in the mid to low single digits. So that's helped the consumer. It's a positive story in terms of its infrastructure development that's driving growth. So yes, there you're generally seeing a relatively stable consumer helped by low inflation.
Coming up, we catch up with one fund manager who is all in on the creative sector for this month's Investing Africa. While many investors on the continent are focused on the budding technology sector and established industries such as mining and logistics, one fund is turning its attention to the creatives. Hiva Fund looks to fuel the growth by facilitating financing at different stages of the creative process. I spoke to the company's managing partner, Wakiru Njuguna.
We are seeing that within the creative space, there hasn't really been a lot of focus in channeling capital towards infrastructure. And so that automatically puts African creatives at a disadvantage. However, the current flow of capital towards infrastructure or interest in moving capital towards infrastructure will definitely be a really positive or have a very positive impact on the sector because it lowers production costs, access to production areas, access to spaces becomes a lot more easier, and that means that creatives can do a lot more production, locally. There is also, looking at infrastructure, both from a physical perspective, so physical infrastructure like studio spaces, event spaces, as well as digital infrastructure, which is also really, really important because we're seeing a lot of, creative entrepreneurs now operating on the digital front. And so I think, seeing these shifts is definitely a positive shift. We actually hope that we can see a lot more money being channeled, towards infrastructure because we've been it's been a very underinvested area. And then we'll start to see the positive impacts of having local infrastructure for the creative space.
So then how does Hiva Fund, where is Hiva Fund channeling some of your investments, if not infrastructure necessarily?
Yeah, so we do channel our investments towards infrastructure, but I'll also give you the scope of work and where we primarily see also other opportunities. Working capital has become more and more prominent in terms of there being a gap for creative businesses. So if you think about production capital, expansion capital, whether it's servicing orders or meeting, clients' demands, a lot of businesses really struggle in this area. And that's because traditional banks either take too long to process the working capital requests, or they don't necessarily have these opportunities for creative businesses to access. And so we channel our funds, or rather our investments, towards working capital, and we do that in various ways. There's the way in which we move money directly to the businesses because we see the need. So if they have like a local purchase order, we channel funds towards that. But then there's also what we are seeing now is that a lot of creatives are operating in communities, whether it's on e-commerce platforms, whether it's on aggregator platforms. And our interest is to really unlock these working capital challenges for creatives.
And that's Next Africa for this month. But don't forget our weekly podcast with more of what's happening across the continent, available on Apple, Spotify, and wherever you usually get your podcasts. You can also subscribe to our bi-weekly Next Africa newsletter, available on the terminal and website for even more reporting from the Bloomberg team. But for now, I'm Jennifer Zabasaja in Johannesburg. We'll see you next time.